Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. It is a happy day in the markets. The S&P 500 is right at about 4480. That's up about 1% as I speak. And it's once again within that sort of 4400 range that we've been talking about on some of our prior updates. However, it's towards the higher end of that range, and all of that's driven on the back of a very positive CPI report, which came out this morning. And we'll get right to it. A lot of I think, positive news in there for fans of the soft landing story. You know, inflation rate was up 3% year over year. That's a great headline number to have. Remember, the Fed's target, at least ostensibly, is 2% year over year. So we're getting much closer to that number. And in the core, the year over year number was about plus 4.8% year over year. You know, that excludes food and energy prices. Food has been a little bit deflationary. You know, I would just say that plus 4.8 is once again a great headline print, certainly trending in the right direction. What I think is even more exciting is what's going on in the month over month number, which is in June. That was 0.2% year over year, which is actually the lowest month over month rate that we've seen since August of 2001. So if you've followed us in the past, you know that we've talked about how that month over month number in the core really needs to kind of average somewhere around 0.1, 0.2 for a couple of months before the Fed's going to decide that maybe the fight against inflation is over. And this is certainly the first month that we've seen a print that low, but it is the, you don't get a trend unless you start somewhere. A journey of 1,000 miles, or in this case of 4 or 5 months, has to start with the first month. And, you know, this is a great indication for the market that inflation continues to cool. The other thing that I will just say is a more subtle positive in this note is that it's really rent and housing that are elevated in the core right now, sort of above that 0.2% month over month. And those tend to be trailing indicators. So they tend to lag a little bit what's actually going on in the economy, which, you know, economists are aware of, the Fed is aware of. And so it's actually really nice to see, hey, not only are we kind of at an acceptable level in the core, but it looks like we might have a little bit of a tailwind in terms of not as much inflationary pressure going forward as that rent indicator comes back down in more line with what's actually happening in the marketplace. So that's great. I think it's giving the market hope that we are kind of done, or at least very close to done, with the interest rate tightening cycle, and that we aren't going to get the recession that every major bank was calling for as a foregone conclusion, which we'll come back to in a second. I will say odds are that the Fed will raise by 0.25% at its July meeting. That's fully baked in and expected at this point. However, I think today's report puts a question mark around whether or not they have to go any higher than that. You know, they may just be permanently on pause as they wait and see how this kind of all shakes out. I will come back to those recession predictions because there's nothing better than pointing out when somebody was wrong. You know, I will just say, when you go back and look at all of the financial forecasts that were coming out late last year, the beginning of this year, it was the foregone conclusion that the economy was going to be in shambles and we were going to get this giant economic contraction. Certainly, it doesn't look like that's the case today. But it does speak to the, two things. One is the danger of, the kind of herd mentality, but two is the fact that everything's always kind of uncertain and you kind of have to approach the market that way. I remember, 6-7 months ago, we were talking about how, 60-70% of major bank economists were predicting a recession in the next 12 months. And now that number is dramatically lower. So it does, once again, speak to a little bit of the, hey, you can't predict this. And so you should kind of approach the markets with that knowledge in your back pocket. With that, as always, if you have any questions, please feel free to reach out to either myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.